Welcome back. The federal government will offer around 80 billion naira through the Debt Management Office in its bond auction for November. Now, the auction will see the reopening of a 15-year and 25-year papers, while the bond settlement takes place on November the 20th. Well, this is coming amid the diversion of funds from the debt markets to the equity market. But let's talk to the acting managing director at Cordus Asset Management, Gbolahan Aina, for more on this. Good morning, Mr. Aina. Thank you for joining us on the program. So around 80 billion naira worth of bonds on offer for subscription this morning by the DMO. Do you see some oversubscription as projected by other analysts or otherwise?
Good morning, BC. Thanks for having me. So for today's auction, really I expect an oversubscription. If you take a cue from what we had last auction, was more than 5 times oversubscribed. Look at the bid to cover ratio. Today the DMO is having to reissue, like you mentioned, the 15-year term to maturity and 25-year term to maturity. From the last auction, they were going to raise just 15 billion, but they took 45 billion, and they were allocated a competitive bid of 4.97% for the 2035 and 6% for the 2045. But run up to the auction, we've seen a lot of bullish trade in the bond market, with investors taking a lot of position. There's huge system liquidity. We expect to see some of those funds come into the debt market today. So I expect an oversubscription. I expect the 35-year maturity to close between 4.95 to about 5%. And I expect the 2045 maturity to close around 5.95 to 6.15%. It's interesting to mention that the run up to the auction, about 40 basis points has been lost in terms of yield. And that speaks to the fact that a lot of investors, local fund managers, and PFAs have been investing in the bond market. But we've seen a lot of reinvestment at the lower end of the curve, and that's because more maturities have been reinvested at that level. But we expect that after the auction, we expect to see some bullish trend at the upper end of the curve.
Now, just like you alluded to now, there's more than enough liquidity in the financial system at the moment, which of course could possibly fuel the subscriptions today. But how do you expect that to shape the stop rates and why?
So because of excess liquidity, and we expect PFAs, investors to want to ensure that they get their bid. So I expect people are going to bid quite low just to be sure that they're able to get into the auction. So I expect to close lower than it closed on previous auction. Like I mentioned, previous auction, the 2035 I closed at 4.97. I closed about 4.95 today. The 2045 closed at 6%. I expect to close a bit lower today. So I expect to see huge subscription. Last auction was 5 times oversubscribed. So I expect to see oversubscription to that tune as well. Maybe about 5 times oversubscription as well today.
Now, tell us, what's responsible for the higher returns on FGN bonds as compared to the Treasury bills?
So the FGN bonds really is not that the return is quite high. I would even say that the return is low. So if you look at a 12-year, a 50-year bond, for instance, it's currently trading at about 7%. That is quite low. When that bond was issued, it was issued at 12.98%. So because of limited outlets, we've seen a lot of investors show interest in that bond, and that has pushed down the yield to currently at 7%. So the way the yield curve works is for lower tenor investments, the yield should be lower, and for the longer tenor investment, it should be higher. And that is what we currently have now. The yield curve is not inverted; it is a normal yield curve. However, in terms of where the yield should be, we think it's quite low. When you look at where our inflation rate is at 14.23%. That means people are having a negative return on investment. If you have inflation rate at 14.23% and a 50-year instrument is at 7%, that's a negative return of investment about 7.23%. So that's really a disincentive to want to put money in long-term instruments. That's a disincentive to want to invest in short-term instruments. And that's what we've seen play out. And I think that's what has even contributed to the rally we've seen in the equity market. The equity market has rallied and it's really on steroid. So there's been a bit of pullback in the last 2 days, but really the trend is still we expect to rally because there's so much liquidity in the system and people don't want to invest at low yield. Good enough to mention that the treasury yield rate is quite low. 1 year at the last auction was 0.3%. The 1 today was 0.15%. So those rates are quite abysmal, and most investors will not want to put their funds in such low rates. So the bond is low, but it's like you mentioned, is a bit better than what we have in the treasury bill market at the moment.
It's typical of fixed income dealers to, of course, return to the secondary market the morning after the auction to take position in unmet demands at the auction. But what's your outlook of the secondary market tomorrow?
So I expect to be bullish. That's always been the trend. So a lot of people that missed out at the auction, they want to cover their position. And we're going to see a lot of bullishness tomorrow when the result comes out. We expect to see a lot of bullishness. People that couldn't get at the auction, they need to fill their auction. The way it works is that people have allocation based on their portfolio, and certain money needs to be allocated to bonds. So rather than leave that money in cash, we want to get a bond instrument. So maybe PFAs, local asset managers want to fill that unmet position. So definitely a lot of bids are going to be unmet. Just about 80 billion, like you mentioned, is on offer. And like I said, we expect to see way in excess of that, probably about 5 times of that amount that is being issued. So all those unmet bids are going to come back, and there's going to be a lot of activity in the secondary market tomorrow morning. And that's going to drive the yield down from where it's going to close at the auction.
Well, we've seen real interest rates decline generally at the debt markets, yet yields keep sliding due to demand. So tell us, at what end of the yield curve are investors more concentrated now, and why?
So for the PFAs, the professional fund managers, because they manage long-term funds, and so a lot of their instruments are in the long-term bonds. And really, because they are trying to immunize their portfolio, what I mean is that because you have a long-term liability, you want to have long-term assets. Also, the long-term yields were quite higher than what the short-term yields were. So rather than want to just invest in the low end, invest in the long end. And there have been a lot of investors trading the bond markets. So you've invested at a higher yield. By the time you depreciate, that means your price has actually appreciated. So interest has really been at the long end of the curve. But now, because the yield is not too attractive, so there's been a bit of pause at the long end of the curve, and we see more activity at the short end of the curve now. And because those funds have been over maturities are short tenor, so those over maturities have been invested in short-term funds. But after the auction, I expect to see some bullishness in the long end of the curve. But in terms of the total portfolio, really is more concentrated towards the long end of the curve.
Now, the DMO is expected to make the bonds coupon payment on Friday. Will that in any way be a catalyst for some interest in the equity markets where, of course, the banks and the PFIs have shown some interest lately?
Definitely. So it's going to be a catalyst for the bond market and also for the equity market as well. So there's liquidity, and liquidity can be idle. Those funds need to be allocated, and really investors always look for where I can get the best return. In the past, bond has given investors one is safe haven and also good return. But because yields are not at comfortable level at the moment, we've seen a lot of those money go into the equity market. I expect to see the same. So like I said, it's showing a bit of pause in the equity market, but we expect to see renewed interest going forward. So the bond payment, some of it will enter the equity market, some will also go into the bond market.
But with all of these now, how should investors trade the fixed income market?
So now it's you need to properly allocate and align your portfolio. Now objective is key. In the past, for a lot of investors, they didn't really care about objective. And I will explain. So people had long-term liabilities, long-term obligations. You probably need to go and build a house or go for a master's or travel. Some of them are long-term projects. But because the long-term end of the curve was given attractive interest rates, if you backtrack about 3 years ago, Treasury bill yield was as high as 20%, 22%. So really, there was no incentive to put your funds in long-term instruments. So that has changed now. So for investors that have long-term liabilities, you can play the bond market, you can play the equity market, because that provides capital appreciation benefits. But if you're having short-term obligations, for instance, it might not make sense to just put your funds in the equity market or put your funds in the bond market. So you need to properly align your portfolio. And really, for a lot of investors, they have an allocation strategy, depending on how much they can allocate to bonds, how much they can allocate to equities and money market funds. But just to round up the question, right, to properly allocate your fixed income instruments, try to immunize your portfolio. So try to invest long-term funds in long-term bonds. and also look at your duration, for instance, outlook for interest rates. In the short term, outlook for interest rates is that yields are pretty going to remain short, pretty going to remain low. And if you think yields are going to remain low, you don't want to go too long. So you might want to stay short in terms of yield, and when yields improve, you can now go long. So if you have a long-term investment, for instance, long-term liability, it might not make sense to just lock in those funds now completely, because at some point yields are going to improve sometime next year.
All right, well, now let's just touch on some other issues now. Talking about inflation now at 14.23% and an expected negative GDP, what will be your expectations as the Monetary Policy Committee of the Central Bank meets next week?
So the MPC really, they are in a difficult situation. Is one that they're in between the rock and the hard place, and so it's quite difficult. And it's because there's no easy answer, there's no easy solution. So there's on one hand there is inflation, on one hand there's negative growth. So they need to make a decision that really balances everything. If you look at the body language of the MPC and last meeting, 6 of the members voted for a decrease in the monetary policy rate, while 3 voted for status quo and 1 person voted for an increase. So really the body language of the MPC is one to address the negative growth. And that is in line with consensus of most central banks around the world. They are dealing with COVID-19, growth has been slow, they've been locked down, economy is not booming, people are not able to produce. So really that is central to to what the MPC wants to achieve. So I believe they're going to go for an expansionary policy. I might not expect them to reduce rate now because they just reduced rate the last meeting. I want to see how it plays out for a few more months. So I expect a status quo at the next MPC meeting next week. And really that's to ensure that the policy action that was implemented at the last MPC meeting to see how it pans out. So I expect a status quo, but really the focus of the MPC at the moment is growth rather than inflation. Inflation seems to be a lost battle, and because the factors that cause inflation are cost push inflation, not demand pull. So inflation is really affected by 2 things, either a demand pull factor or a cost push. One is that there's so many farmers chasing few goods. The cost is really structural factors, like what we have now in terms of farm incidents, what in terms of transportation, what we have in electricity. Those are structural factors that an increase in rates cannot address. And so really they can't increase rates to address that. So rather than just focus on what they think they can address, I really that is growing the economy and making funds available to the private sector and the real sector. So I expect to talk about the next MPC meeting.
Now, with all of these factors that you've mentioned now, how would you say investors should recession-proof their portfolio?
Okay, thanks. So that's a good question. So really, recession is an obvious fact, and it's facing everybody is certain our face, and it's always good to recession-proof your portfolio. And really, because most people fall back on their investments to meet their needs. If your income is not enough, most times your investment is like a fallback. And at the moment, equity seems to be giving a lot of return. Equity gives you a capital appreciation benefit, also gives you an inflation edge. But one of the advice is to have a balanced portfolio, and it's always good to diversify your portfolio. Most times, we just see the portfolio just concentrated in one asset class, and that can become risky because asset classes can flip. But if you have your portfolio diversified across equities, across fixed income and money market, you're able to take advantage of the various vagaries in the market. So one is to have a balanced portfolio of equities, bonds, and fixed income. It's better to play the fixed income market now, and play the equity market now. So it's better to have some of your funds allocated in fundamentally viable stocks and not just any stock. Also good to have maybe some funds in dollar investment. And the reason is because dollar gives you an inflation edge and it also gives you a currency edge. So if you have some dollar funds, you can put it in dollar funds or you can put it in euro bonds. Euro bonds yields at the moment currently offer either what you get in your local sovereign bond. So that can give you a sort of protection. So one is to look at currency, if you are going to recession-proof your portfolio, and also diversify your portfolio. But the retail investors usually advocate mutual funds, having some of your funds in mutual fund, because mutual fund is the way that professional fund managers help you to manage your funds. So you don't really need to think or what about the fundamentals of the company. Somebody is doing that for you and ensuring that your funds are protected and your funds are being optimized. So two things: one is to have some of your funds in dollar instead of dollar obligations, and also to have a diversified portfolio in equities, in money market and fixed income. That will help you to restructure your portfolio.
All right, we'd like to thank you, Acting MD at Cordros Asset Management, Bolan Aina. Thank you for sharing some of your time with us this morning.